Hello everyone. Today we are in discussion with Mr. Vishal Kapoor, who is the CEO of IDFC Asset Management. Mr. Kapoor has over 2 decades of experience in financial services, and before being with IDFC, he was at Standard Chartered Bank. And largely, I would say that IDFC has been one of the very few AMCs that has tided over the last 2 years that we have seen turmoil in the debt markets very nicely being not affected much by it. So clearly, it has been focused with a few fund managers also being on the forefront of helping people understand how debt markets behave. So yeah, Vishal, if you would like to add anything about yourself, IDFC, we would do that. Yeah.
Thank you, Ankit, and thanks for having me here. It's a real pleasure. At IDFC, again, our attempt has been to try and keep things very simple. And
Sure.
the funds that we create and manage is managed to a very specific definition or framework. And clearly, that has held us in good stead for our investors over the last few years, especially on the debt side, but also on the equity as well as the hybrid side, because we offer a full range. And we continue to hope and pray that as we come out through this crisis that we are undergoing right now,
Mhm.
does eventually look at the opportunities and end up making money over the long term.
Sure. So basically, going into what our investors would like to know from you, being a veteran in the industry, I guess we have talked enough. Like we also do a lot of active advisory and trying to explain people how to go about it. But I guess from a veteran like you, people would again like to know that when you say about asset allocation, the importance of debt and equity in your portfolio, how do you explain that importance to people? And specifically, a lot of retail investors don't understand the concept of having debt in their portfolio in mutual funds. Most of the money is in equity. So how would you give that importance and sense of understanding?
Right. So thanks, Ankit. And I do understand and appreciate that as an industry, we can often use very heavy sounding words.
Mhm.
But believe me, this is all quite simple at the underlying, fundamental level.
Mhm.
So asset allocation sounds like a big word, but it is just, being able to divide up your investable corpus or the money you have into different assets or types of instruments. So equity, for example, is something we would consider as a large asset class. Similarly, debt is a large asset class. Most people have cash or some form of immediate savings as an asset class. Real estate, gold are two very popular asset classes in India.
Mhm.
So that's what an asset allocation is. It is just dividing up your total savings into different types of assets.
Mhm.
Now, why is it something that we like and that we advocate? It's simply because that each of these assets tend to move in a different direction or at different speeds. And what that does is that the total amount of saving that you have benefits from both the growth as well as the stability component of the fact that these assets are moving in different directions or at different speeds. So, for example, if the equity market is going up very rapidly, then the equity portion of your portfolio goes up with it. On
Mhm.
the other hand, if the equity market falls, the other parts of your asset, like debt, for example, may not follow at the same time. So, therefore, it provides some amount of cushion or a shock absorber to your portfolio so that you're not necessarily riding just one single horse to get your savings the benefit of growth. So in one sense, look at it as a chariot with many horses and everyone's pulling. So just because one is pulling faster or slower, you actually end up having a better ability to get to your destination.
Sure.
Now, various studies have actually shown quantitatively over different periods of time that in the context of a portfolio, which is me trying to save for an objective, the importance of asset allocation is far, far larger than any other aspect of the portfolio, like stock selection or timing or which manager I chose or which type of scheme or which type of charges or expenses, etc. So this becomes the most important factor
Mhm.
that one has to look at when deciding how to go about investing.
Sure. Sure. So coming to, like, we will go in parts. So as you have explained asset allocation, we'll first look at equities and then probably move to debt. So in equities, I guess, like some people might be sitting and just wondering as to what happened. Like in the last 2 months, it has been such a crazy journey. And given in the last couple of days now with this oil and everything happening, people would just be wondering as to, is it that is so volatile that probably doesn't make sense. So what will you suggest to them? Like, how would you explain them? Okay, it's for the long haul and you have to stay invested. So what would be your suggestion?
So I think anyone who's invested into equities, one should anticipate and expect volatility. Like we've always, I think everyone that you would have spoken to would have advocated that. It's just that the level of volatility can sometimes be very, very acute, like we are seeing right now, almost unprecedented. In this case, of course, higher amount of volatility has been seen in the past. So this is not the first time, and I'm sure it is not going to be the last time either.
Mhm.
Because at a fundamental level, equity markets are always looking to the future. So when something like a pandemic hits and the size and scale becomes more apparent, and people like start looking at what is the impact and the outcome of that impact, or the hypothesis that we have in terms of economic slowdown and job losses, industries getting severely strained over the next few quarters, maybe a few years, all of that gets absorbed. There can be an immediate reaction. So even before the actual earnings have been hit, people will anticipate that and make the move. When lots of people are doing that, then one can obviously expect a crash, because the market is just demand and supply. So
Mhm.
everyone is trying to sell because everyone's seeing pretty much a similar picture. Of course, it can be aggravated because FPIs are pulling out money, which is a large quantum, and then there are leverage trades, there are hedge funds, there are ETFs, etc. All of them are stop losses get triggered and leverage gets unwound. So all of that accentuates or aggravates sometimes this fall.
Okay.
So that's what would happen in any such situation. So what we are seeing is not, therefore, like I mentioned, so abnormal. It is quite understandable that you would see a very sharp correction. Now, how quick, how steep is always going to be different every time. And clearly, we have seen an unprecedented steepness in the correction from almost a 52-week high to a 52-week low
Mhm.
within just a matter of a few weeks. So it's very significant. Having said that, that's how equities behave, and which is what then underlines the importance of allocation. So thankfully, the other part of your portfolio, whether it is cash or whether it is debt or maybe it is gold, that would still be fairly secure and stable. So that would absorb the level of shock you have.
Okay. Okay. Uh, so basically, if somebody was willing to use this correction as a way to put in fresh money, would you advise people to go into which category of funds, whether it should be large caps, mid caps, large and multi caps, given there are so many categorizations right now? Which category would you recommend, irrespective of whether those funds, irrespective of IDFC, in general advice?
Right. So I think, if you're looking at fresh investments right now, I think it's important to go back to the basics to understand why is it that you want to invest. Because keep in mind, Ankit, we see both types of reactions. When a market move that we've seen happens, we can see a panic sell. So a lot of people just, sell their equities or stop their SIPs or redeem, etc., because they think it is going down further.
Mhm.
At some stage, we also have people looking at opportunistic buys, right? Now, both of these actions may be true or false or right or wrong, depending on what your objective is. And that's what we want our investors to focus on. So, for example, if you're in the camp where you are rebalancing your portfolio, because keep in mind, even the sharp fall that we've seen in equities means that it is likely you have less equities now as a proportion than what you want,
Correct.
and therefore it may make sense to just rebalance.
Correct.
Now, if that's the objective, then I would say go back to what your original allocation was meant to be. So for example, if it was meant to be a broad-based allocation across large cap, mid cap, and small caps, then try and go back to that level.
Okay.
Of course, many people will say, based on data, that When pullbacks happen, typically it is large caps first and then mid and small cap typically follow. But that's typical. It may not always happen. And also we have to go back to, to the fundamentals to say, is this an investment you're making for the long term? Or is this a very active strategy? It's a tactical part of your portfolio. And once the pullback happens, you will get out again. Now, most long-term investors, most retail investors should not try and get into that level of timing. So to that extent, I would say that just go back to reassessing or going back to your goals, see what the intended allocation was, and use this opportunity to rebalance it. If you have money for a tactical portion of your portfolio, then yes, this could be a good time. But keep in mind, no one guarantees that further falls may not happen. As news flows come through, there could be further falls. So one has to be ready for that eventuality as well.
Mm-hmm. Okay. Makes sense. So ideally, you are trying to say that for regular investors, they should not be trying to time which sector or which market cap. They should go back to their original allocation that they had, say that they initially decided, and stick to it. Rebalance it if needed because of equity correction. That's it, right?
Okay. That's right. And again, in that, I would think that for most portfolios, one would have in the equity bucket, you would have a mix of large caps, mid caps, and small caps. Okay. So rather than only being opportunistic and saying, putting all your, in a sense, eggs in one basket and one part of the market, you could go back to, the original, because all parts of the market have fallen in this steep slope that we've seen over the last few weeks.
Sure. Great. So since we have now understood mostly on the equity side, let's move to debt. So basically the first question there will be, the investors would like to know what has been the secret behind IDFC's success on the debt side in terms of not being affected through all these credit events over the last 18 months. What have we done differently?
So to be honest, Ankit, we haven't done anything very differently. We've been sticking to a fairly simple philosophy and framework for the longest time. So like I mentioned at the beginning, the framework and the philosophy and a simple set is very important for us. And the framework we use for managing our debt, just looks at what the investor's objective could be or should be. And accordingly, we have products against each of these buckets. So let's look at the investor's needs in a sense. In most cases, one part of our money is kept in what we call the liquidity or the cash bucket, which is money I'm parking for the short term. This is money typically in either a savings account, in very short term deposits, etc. Money that I need to access. Now, this type of money, when we come to the debt market, is generally kept in the overnight funds or cash or liquid funds. These are managed with highest amount of safety and liquidity because you cannot expect any loss over there. Okay. The second bucket, which is the largest part of where we think the Indian saver wants his debt money to be, is what we call the core bucket, which is simply as close as possible to a fixed deposit, which is we know a tenor of time, whether it is 6 months or 3 years or 5 years, for which we want to save this money and we want a reasonable return out of that, but we want very high safety.
Sure.
So then this bucket is managed across a full spectrum or ladder of tenors with the highest level of safety. And of course, mutual funds have the benefit of daily liquidity and therefore that's an added benefit to you. So here, each portfolio has the best quality assets that are available in the market, whether it is AAA or government or quasi-government assets. And that's where the bulk of the money, to our mind, for the saver should be, because they are looking at a replacement for fixed deposits with some amount of added benefits like liquidity or maybe higher returns. When we are looking at the third bucket, which is where someone is now chasing some more returns, maybe 100, 200 basis points, 1 or 2% more than what a fixed deposit can give you, that's when we must recognize we need to take risk. And that is what we call the satellite bucket. Now, in a satellite bucket, you should recognize you're taking more risk. You can take risk by taking on lower quality debt or credit, as it is called, or you can take risk by going up and down the yield curve, which is called duration risk.
Sure.
Both these risks may lead to some amount of volatility. It can give you higher returns, and sometimes it can have some accidents as well, depending on whether you got the call right or what was the credit environment, etc. Now, during phases, this can underperform, and in some phases, it will outperform. So the last 2 years or so, we've seen a phase where it is underperformed because of the credit stress that has come up in the environment. There's nothing wrong in it as long as you know that this is risky assets and it can underperform in the short end. And therefore, take a very considered view of how much money you can allocate here. So to our mind, the challenge to an investor emerges when we did not understand this framework and we over allocated into a risky bucket without understanding that this can go through some periods of underperformance. So if you want to play it safe, then the bulk of the money should be in the core bucket, which is where you're getting high quality assets with very high liquidity. And that is where we think that investors have managed to get very stable returns, not just in the near term over the last few months, but even in the long term.
Sure, got it. I'll probably add one more point here because a lot of our investors might be first-time investors. So the core bucket that Vishal is talking about, in that core bucket, the target is to make returns close to bank FD returns. And you might be thinking, why is then it important to invest in mutual funds? Clearly, the answer is, as Vishal also said, there's everyday liquidity that you get. But for most of you, there might be tax benefits that you will get if you, that is called the indexation benefit in debt mutual funds, if you do it over more than 3 years. So, and hence your post-tax returns will be much higher than FD returns. Correct, Vishal? So that will
That's right, Ankit. I think thanks for highlighting. What we have seen is that even in the core bucket, which is products which are largely matched to fixed deposits, over a full cycle of boom and bust, even in the debt market, we have managed to provide returns which are generally slightly better than the fixed deposit returns. And you also have the benefit of daily liquidity. So these are two very good advantages that you have with the open-ended mutual fund.
Great. So Vishal, now in the current scenario that we are in, because of the pandemic that we are seeing and whatever is happening, all across the banks have been cutting rates. Even the government has cut rates on their various schemes that are out there, whether it is the PPF or the post office savings or whichever savings. So ultimately, if I was making, say, 5%, 6% returns on my FDs, or say, let's say, savings bank accounts also for a few banks, they are now down to say 4% odd. Same is the case in debt mutual funds also. So does it, how should an investor think around this? Like, should he do something to his asset allocation or the 3 buckets that you said? Or is it like I should probably get my expectations right for the near term? How would you put it?
Yeah, Ankit, so I think very important to to address that, because in many of our cases, we anchor to a specific return number as if that is the right number. But the other way to look at it is that any return number that we have for whether it's a fixed deposit or any other saving scheme offered by the government for tax efficiency purposes, it is finally anchored to the rate of inflation and the rate of interest rates in the environment.
True.
So if the interest rates in the environment come down, like we're seeing right now, with inflation also being quite low, it is natural that all interest rates in the system will come down. Right? Sure. Because keep in mind, there is lower growth and lower inflation. So to that extent, it's not as if it's a bad thing for you, because your real growth on the money that you have is still going to be possibly as attractive as in the past. So let's look at the situation today, because I do feel that while many investors think that the environment for debt is bad, actually it is extremely attractive. And I'll tell you why. Because in the current market, the high quality papers or investments that are available in many of our funds, where we are not taking any risk per se, we're just investing in very high quality end of the market. The yields that are available relative to other benchmarks like either inflation or the repo rate, so the spread as it is called in the market, is actually at close to all-time highs. which means you are getting very well paid for being in debt.
Correct.
I would encourage investors to not look at the headline rate, but really look at relative to inflation, how much money are you making? Because that may be a better way to gauge your expectation as well as returns in the future.